My name's Kevin Kedra here with Gabelli. I've been with the firm for about 16 years covering pharmaceuticals, a little bit of biotech, and animal health and some of the other healthcare areas.
So let's start with financial engineering. Can you give a quick explanation about what you mean by that term?
Sure. So when we talk about financial engineering, what we're talking about is companies really finding a way to rearrange their business in a manner that can create value for shareholders. Or at least that should be the goal. That's not always how they play out. It often involves separating a segment or a business line, and you can achieve this by spinning it off directly to shareholders. You can do an IPO where the parent company gets some economic benefit, or even a transaction like a reverse Morris trust, which is kind of a combination of a spin-off and a merger that carries certain tax benefits. Now, it's important to consider tax implications when you do financial engineering, because you'd hate to see a company take actions to create value only to have a sizable portion of that end up going back to the IRS.
And what are some of the recent examples of financial engineering that we've seen in pharma and healthcare?
Well, we've really seen them across the spectrum. I mean, just recently we had both Pfizer and Merck, which are two of the biggest pharmaceutical companies in the world. They did some financial engineering. In Pfizer's case, they had a legacy pharma business, which they called Upjohn. It includes former blockbuster brands like Lipitor, Lyrica, Viagra, big brands once upon a time, but they've lost patent protection in the U.S. and in most major markets, but they still generate significant revenue internationally. So they chose to spin this business off to shareholders, and then they merged it with a generic drug company called Mylan to create a new entity called Viatris. So this is an example of that reverse Morris trust that I was talking about. In Merck's case, they did a more direct spin-off to shareholders by taking their women's health business. They took their biosimilars and then their legacy pharma assets, similar to Upjohn, and put them into a new public company that's now called Organon. In the animal health space, actually two of the biggest players, Zoetis and Elanco in that sector, they were both spun out of pharma giants, Pfizer and Eli Lilly respectively. And we've actually got a few more on deck. So that includes GlaxoSmithKline, which is planning to spin off its consumer health business. You've got the biotech company Bluebird, which is separating its cancer business from its genetic rare disease business. And then Bausch Health, which is actually they plan to separate into three companies. So you'll have an eye care company, a medical aesthetics company, and then a legacy pharma business.
What are the advantages of spin-offs and separations?
Well, as I noted earlier, the goal of these transactions should ultimately be to create value for your shareholders. And you can actually achieve this in a lot of ways. When you do a spin-off or separation, you're taking one large company and you're turning it into two, or in some cases even more, smaller companies. And often one or several of these are pure play type companies. One reason to do this may be to unlock the value of a hidden asset that could command a premium multiple in public markets relative to where the larger corporation trades. So I mentioned earlier Zoetis and Elanco, both being spun out of big pharma parents. And part of the motivation there was recognizing that animal health companies trade at a significantly higher multiple of earnings and EBITDA than their big pharma parents. And at other times, a separation may allow an underinvested asset to flourish on its own with renewed attention. You get better capitalization and sometimes a dedicated management team, which can be important. So this will allow the parent company to concentrate on its core areas of expertise. Merck's separation of Organon is probably a good example here. Merck had largely ignored its women's health business, but now as Organon, there'll be a renewed effort to invest behind women's health and the other efforts at that company. And for Merck's troubles, they got $9 billion in cash as part of the separation. So they were able to deploy that for acquisitions, and most recently they announced a deal to acquire a biotech company called Acceleron for $11 billion. So you saw them taking that cash from Organon and putting it to work pretty quickly. And then separating into smaller companies, it also simplifies things. Might make it easier for one or more of the pieces to eventually be bought by a strategic acquirer, even though there are some tax implications around when a business can be acquired following a separation. But when you look at the healthcare giant Baxter, who spun out its pharma business called Baxalta in 2015, that was quickly acquired almost the day after. Shire came after them and eventually bought that business for $32 billion. And then the biotech company Biogen, they spun off their hemophilia business into a company called BioVeritiv, and that was quickly bought up for about $12 billion by the French pharma giant Sanofi.
Are there any disadvantages to financial engineering?
So there are certainly some potential disadvantages to when you split up a company. So I mentioned how the animal health companies benefited from favorable trading multiples, but that can go in the opposite direction if the spun-off asset is seen as lower quality or less desirable or durable than the parent company. So Organon and Viatris, both of these with their legacy pharma businesses would be examples here. Both these companies are trading at a significant discount to their former big pharma parents. So the parent company is also giving up significant financial firepower that helps support things like a dividend on an ongoing basis. So if a company is spinning off a segment that was a meaningful contributor to their earnings, that parent company may then be forced to cut its dividend to account for the reduced earnings power that you get following the separation. Ideally, you might get it back on the other side of the separation with the SpinCo, but that's not always the case. You also tend to have stand-up or separation costs that occur when you split up. So when two companies merge, you often hear about synergies or cost savings that can occur as a result of the combination. Well, that flows in the opposite direction. When you break up a company, you usually end up with some level of dis-synergies. And last, but certainly not least from a stock trading standpoint, you could see greater volatility in both companies following a split-off. So you have investors who may have owned a blue-chip company like Merck for years, and then all of a sudden they have this other company, Organon, in their portfolio from the spinoff. Well, a Merck holder may not want to be an Organon holder. So you could see heavy selling of that spinoff company. And this happens with both active and passive investors. So if you're an index fund that holds Merck and suddenly now you have shares of the smaller company Organon that isn't supposed to be part of the index, well, you basically have to sell it.
And why does it seem like so many healthcare companies do some sort of financial engineering?
So when I last looked at the 25 or so announced spinoffs that are still pending, I'd say close to 40% of them were healthcare related. So you're right in that healthcare is probably overrepresented in the area of financial engineering. I mean, healthcare is a very diverse area. It accounts for over a sixth of our GDP, so that covers a lot of ground. I think some of this is a function of the level of M&A activity that you tend to see in the industry. So when you have sizable mergers, you're adding additional layers of complexity to what is already a complex industry. I mean, even Donald Trump back in 2017, when he said nobody knew that healthcare could be so complicated. I mean, we all knew that, but this is another example of it. And if you do a split up or a spin-off, you can bring a little bit more simplicity to what is a very complicated arena, and that can be good for shareholders, and that can be good for potential buyers as well. And when you look at how big healthcare is, there are so many subsectors that can really stand on their own merit as an independent company. And these subsectors can have very different growth rates, different product life cycles, different funding requirements when compared to the broader healthcare market or between one business to another. So maybe the other reason is probably because so many, particularly in pharma, have been so successful. So you've got Alcon, AbbVie, Baxalta, Bioverativ, Zoetis. I mean, these are all recent success stories of spin-offs and IPOs from larger companies. And you go back further, you have names like Mead Johnson, Medco, and even Monsanto, which I think people may not realize was actually spun out of what today is Pfizer. So these have all been success stories of financial engineering.
Is there any upcoming spin-off or separation that you're keeping a close eye on?
Yeah, so the one that I would call out is Bausch Health, and the ticker there is BHC. So as I mentioned, they're planning to spin or split up into three companies now. So Bausch has been hampered by a large debt load, about $23 billion of net debt, and some legacy issues from its days. It used to be known as Valiant, and that was a high flyer, and eventually became a notorious name. Given some of the pricing practices that had happened there. And they've since changed management and changed the way that they do business. And the crown jewel at that company now is the Bausch & Lomb eye care business, which a lot of people know. A lot of people use their products, contact lenses, and solutions. They have over-the-counter products. They make pharmaceuticals and surgical products as well for cataract surgery. So they're spinning that off, and that could unlock the value of that business for shareholders. As a diversified player in eye care, you look at the publicly traded peers, Alcon being a spinoff as one of them, but companies like Cooper, they're valued around 20 times next year's EBITDA. It's a very attractive trading multiple, especially when you look at Bausch as a standalone company today trading closer to 10 times EBITDA. So twice the multiple for an eye care company versus what they seem to be getting today. They're also going to IPO their Solta medical aesthetics business. So this is a business that's seen great growth over the past 3 years and wasn't really slowed down by the pandemic at all. Medical aesthetics had a very quick rebound after the initial days of the pandemic. It's been a great growth opportunity for a lot of companies, including Bausch with the Solta business. Now the challenge is figuring out what to do with the $23 billion of net debt. And the plan right now is to have the legacy pharma business, which is kind of your core drug business led by a GI business and a drug called Xifaxan. That's going to carry most of that debt burden so that you have Bausch & Lomb and Solta can have the flexibility to immediately invest in growth opportunities when they become separate entities. So the stock today, Bausch Health trades around $28 per share. But I think if you do a sum of the parts of all three businesses along with the debt, it's worth $43 per share in 2023 and could be worth as much as $60 by 2025. So a double from here in the next 4 or so years. So, it also helps that you have several activists, most notably Carl Icahn, who's the top shareholder with a 9.5% stake. They're keeping an eye on management and will make sure that they get the financial engineering right.
What has the M&A environment for pharma looked like since the start of the pandemic?
Yeah, so we've been talking about companies breaking apart, and now we're going to talk about, I guess, companies coming together with M&A. So mergers and acquisitions, or M&A, has always been a big part of the pharma landscape. I mean, just given the pace of innovation, the risk of development, and just the life cycle dynamics that you have for a new or an existing drug, it makes it very important to a lot of these companies. And like most things, we saw a near halt of pharma M&A at the start of the pandemic in 2020. We did see a slate of tuck-in deals, kind of the sub $5 billion range for a while, until we got to really in the fourth quarter last year, Gilead buying the cancer biotech Immunomedics for $21 billion, and then AstraZeneca had the most sizable deal, buying the rare disease company Alexion for $39 billion. That was announced late in 2020. We haven't really topped those levels here in 2021. The first half of this year was actually really slow. It was pretty quiet. I think Jazz's acquisition of neuroscience / cannabis play GW Pharma for $7 billion was the largest deal we had in the first half of the year, but we're starting to see a bit more consistent flow of mid-sized deals lately. So Merck was the most recent headliner, earlier this month announcing that they're going to pay close to $12 billion for the biotech Acceleron. But we've also seen Pfizer and Sanofi do deals in kind of the $2 to $3 billion range, so we are starting to see some level of consistent deal activity picking up.
Has the political environment had an impact on M&A?
I think so, especially when you think about larger M&A. So the FTC is likely to look much less favorably on large pharma deals under Biden than it did under the Trump administration. And even under Trump, we were starting to see some resistance to some of these pharma deals. For most tuck-in deals, like that'd be sub 15 to 20 billion for big pharma. That shouldn't have too much of an impact, but for larger deals, it could definitely be an issue. We did have AstraZeneca close the Alexion deal that I mentioned earlier. There was a little fanfare to that, so take that as a positive sign, but there's been a definite pause in sort of the mega mergers that used to be pretty prevalent throughout the pharma sector. COVID certainly has something to do with that, but I think the political environment, be it the FTC, or the public scrutiny around high drug prices and the uncertainty about what sort of legislation may be coming down the pipe to address that, I think all that has also likely contributed to what we've seen in the M&A environment.
And should we expect to see more deal activity as we head into 2022?
We certainly seem ripe for more deal activity in 2022. I mean, a lot of the factors to support deal activity are there. So you have well-capitalized companies, some of whom are flush with additional cash from their COVID solutions, be it on the diagnostic or vaccine side, or in the case of Merck and Regeneron, some of these other companies, these therapeutics or antibodies. So a lot of COVID cash that's flooded into the sector. And a lot of these companies are going to be starting to look for growth in the back half of the decade when some of their big blockbuster products are going to face losses of exclusivity. So that's when the patents are up and they could face either direct generics or what are known as biosimilars, so competition directly to the products. That tends to be when you start losing some revenue for those. You also have a lot of the mid-sized companies, particularly in the biotech space, whose valuations are down 20, 30% or so from where they were earlier this year. And then debt is still incredibly cheap for large pharma companies. I mean, these are very highly rated credit companies, so that they can borrow at very cheap rates and put that cash to work to building out their pipelines or buying new products. So, we figured that 2021 so far has set a very low bar on the deal front. Then yeah, I do think we'll see more activity in 2022. And there could be something of a reopening effect here as well, since, many of the seeds for a future deal are actually planted during these in-person meetings, whether it's at industry or scientific conferences. We didn't really have anything in person in 2020. We're starting to see some of that come back. It's not all the way back, obviously, with Delta, but as that starts to come back, as people are getting in rooms together or meeting, maybe not shaking hands, but touching elbows or whatever they're going to do, those in-person meetings are kind of what set the stage for what eventually blossoms into an eventual deal. And I think with that happening, I'm pretty optimistic on the deal front improving as we move into 2022.
All right, that's been very informative. Thank you for coming on. I hope we can have you again soon.
Great. Thanks for having me.
Several companies were mentioned in this episode. We own less than 1% of the following: AbbVie, ticker ABBV; Acceleron, ticker XLRN; Alcon, ticker ALC; AstraZeneca, ticker AZN; Bausch, ticker BHC; Baxter, ticker BAX; Biogen, ticker BIIB; Bluebird, ticker BLUE; Elanco, ticker ELAN; Eli Lilly, ticker LLY; Gilead, ticker GILD; GlaxoSmithKline, ticker GSK; Jazz, ticker JAZZ; Merck, ticker MRK; Organon, ticker OGN; Pfizer, ticker PFE; Sanofi, ticker SNY; Viatris, ticker VTRS; and Zoetis, ticker ZTS. Following today's discussion, I must read the following disclosures. Equity investments are affected by market conditions. The intrinsic value of the stocks in which our portfolios invest may never be recognized by the broader market. The opinions expressed are current as of October 7th, 2021, but are subject to change. The information provided in this podcast does not provide information reasonably sufficient upon which to base an investment decision. It should not be considered a recommendation to purchase or sell any particular security. Portfolio holdings are subject to change. The performance of any single portfolio holding is no indication of the performance of other portfolio holdings of any strategy or fund. Comments made on any individual company or stock is not an indication that it is currently held in a portfolio, nor is it an indication that it will ever be held in a portfolio.